Hi, I'm Noah. I'm on the investment team at Theia. We operate a liquid fund, and I do pretty much all of our trade execution. We got involved in MetaDAO at the beginning of 2025, so I've been trading decision markets for about 18 months. Our first foray was actually our OTC proposal to invest in Meta, which initially got shut down, and it warranted us coming back and proposing to buy at a premium to our initial price. And so my presentation, I'm going to briefly touch on the mechanics of how decision markets work, some of the market participants, and how we participate, and some case studies of how we participated. And so I think we're all familiar with how decision markets work, but just in terms of the actual mechanism underlying, there are four ways to express a view. There's the pass market, and there's the fail market, and there's the ability to either buy an asset or sell an asset in both of those markets. So those are four decisions. And practically what that means is I can come to the market with USDC, in which case I can buy something. I could either buy pass or I could buy fail. And when I express buy pass, I am taking my USDC and I'm getting PUSDC and FUSDC, so the two conditionals. And then my PUSDC is swapped for P token, in which case I've impacted the price of the pass market to move upwards, and I end with a P token. So if the proposal passes, then I get the token, and FUSDC if the proposal fails, and I get back my USDC. And so there are a number of market participants. I'm going to focus on three. Just bucketing arbitrageurs and market makers generally into kind of the high turnover, low discretion, return-oriented investors. Band arbitrage, basis trading, very similar in dynamics. I'll touch on it in the next slide. And then market making, providing liquidity to markets by providing both quotes on the bid and ask. And so band arbitrage, I kind of made up the name, but similar to basis trading, it's two mechanics to make money from the market microstructure from decision markets. And so decision markets, naturally you have the pass price, and you have the fail price, and then you have the spot price. And when spot moves outside of the bands of the fail and pass legs, then you have an arbitrage opportunity that opens up. That arbitrage opportunity is very similar to how a basis trade works, in that when a market resolves, so at the end of the individual market, the spot price should trade in line with whichever way the market decides. So in the event that the market is going to pass, the spot price at the point of that decision passing should be the same as the conditional of the pass market. And so before the end of the decision market, there are opportunities to collect the basis. And the easiest example, to avoid getting into kind of the dynamics of short selling, is buying spot below the pass leg. If spot trades at $1 for the Meta token, you believe that a proposal is going to pass, and the pass leg is trading at $3, you can buy at $1 and sell pass, and you collect a $2 spread, assuming it does indeed pass. Another variation of arbitrage is liquidating, so RFVers. I think we're all familiar with them at a high level. And just going through the mechanics, why this is such a clean arbitrage and why there are so many market participants that are looking to RFV. When a company trades at a discount to the cash value that it has, there is an arbitrage opportunity opened up by liquidating the underlying company and collecting the difference between the spot price and the liquidation value of the treasury. And as a byproduct, what you see is when a large enough profit opportunity opens up, so a token trades at a large enough discount to its cash treasury, RFVers are likely to come into the market to arbitrage. And they're generally threshold. It's not to say that when a token trades at a discount to its NAV that you're going to invite RFVers, but when it trades at a large enough discount for a large enough period of time for an entity to accumulate a large enough position that means a certain amount of profit, it's going to do so. And so you tend to see an accumulation period where an entity accumulates a discount to spot, a liquidation proposal comes up, and in which case this RVer has a bunch of spot inventory and is now going to trade the market to give themselves an exit. And the way that they do that is, one, after buying spot, they can buy the pass market. The pass market should trade roughly at the liquidation value, given that if the liquidation passes, they get back out the cash. And so there's the arbitrage of just moving the pass conditional up to the NAV. And the only way to defend is someone that disagrees with the RFVer is to essentially buy them out in the conditional markets. And that if the pass leg trades at the liquidation value, the fail leg also has to trade at the liquidation value in order for the spread of those two to be small enough to not pass the proposal. And so someone has to come into the market and buy fail. And they have to say, if this proposal fails, we believe the company is worth more than the cash, even though prior to the proposal existing, people did not believe that, given that the spot asset was trading at a discount. And so someone comes in and buys fail up to that liquidation value to defend against an RFVer, and the RFVer is now, with their spot inventory, able to sell the fail market to exit their position, essentially at the liquidation value. And so in practice, you have to fully buy out the RFVer in the sell-fail market in order for the fail leg of the conditional market to trade above the pass leg of the conditional market. And so what this essentially means is that people are forced to come to the market to express a positive view about a company that may have not been otherwise induced to do so before a liquidation proposal was pushed forward. And so the last market participant, and there are definitely others that are excluded, but just to focus more on how we're thinking about markets, is large governance participants. Theia, we manage a liquid fund. Our size is generally larger than many of the participants in the market, and that leads to different dynamics on how we express our views relative to, say, a small active participant. But in general, our goal is not usually profit-oriented on the individual market. We're more so focused on optimizing the value of the underlying company. And those two things are intrinsically related, but it's just to say that we're willing to trade and not focus on the profits of those individual trades within the decision market if it means that the company at the end of the day is going to be worth more if the decision goes in our favor. And so we're trading early. In the first 24 hours of a decision market, you have the opportunity to express your view before a TWAP starts. And in theory, people that are going to trade against you are going to see the change in the conditionals and start to trade as well. So you induce trading to find out who the other participants are within the market. And then naturally, we're optimizing for a TWAP. And so we're focused on limiting the amount of trading that we're doing to maximize the outcome on the TWAP. And this leads to a number of metas, some of which may continue for a while. Many, I think, probably will eventually become less relevant over time. The first one that I feel very confident is isn't going to be relevant in the future is dynamics of different hours and how they impact the pricing of decision markets. And we noticed this. We haven't built out data to say for certain that this is happening, but we noticed that a lot of the participants in decision markets are based in the EU and US time zones, and that the volume on decision markets starts to drop off during Asian trading hours. And so frequently I would notice that I would be at my computer around 10 p.m. trying to get in the final trade in a market before there's a lull period so that you can essentially set the TWAPs for, like, let's say everybody's sleeping on the same schedule as me for 8 hours before someone comes in and trades against me. And so for a single price or a single trade, I can set price for 8 hours, which has a much larger impact on the TWAP than if I was trading and then someone came in to trade against me. The second thing is on-chain recon. So when we're trading, we're seeing all the wallets that are trading with us and against us, and we can go in and see how they've traded other proposals. We can see how much capital they have in their wallets, et cetera. It's not perfect information, but there is information that's given from it. And one of the things that allows us is coordinating and negotiating. If you have someone that's trading against you, it's probably worth finding out why they have a different opinion. In some cases, it may change your opinion. In other cases, you may be able to change their opinion. And so there is a social element to trading these markets. And on the opposite side of things, as a large fund, naturally there is this concept of like big stack bullying. It's relevant in poker. It's relevant here as well, where, you know, if I see someone trading against me that has 50K in their wallet, I'm potentially willing to trade $1 million. I can just trade 50K against them, and then they've been removed as the marginal pricer of a market. And so there is a benefit to scale in these markets, at least in the current structure where you have a limited number of participants, say like less than 1,000. And so practically, I just want to go over 3 examples on how we trade these markets. I'm a bit over time, so I'll try to be brief. The first one is Mountain Capital. We ultimately weren't investors in Mountain when they first launched, but we saw a proposal for a discounted purchase of Radium, which had a pretty high level of individual deal carry. And we thought this was a bad incentive and bad precedent that would be set for Mountain Capital. And so we didn't have any inventory to start. And so our only choice was to buy fail. We could have bought spot and sold pass, but ultimately at this time, Mountain Capital was trading a material discount to the cash value of its assets. And so if we bought fail, we'd be able to buy a company essentially for a discount to its cash, and block a proposal that we saw as value negative. And so we were able to buy fail, in which case the only option for someone to trade against us was either to sell fail or buy more pass. And we were able to continuously buy spot and sell pass as well to remove all the capital on the other side of us, in order to try to get the outcome that we were looking for. Another example is the Ranger liquidation. We had started to accumulate a position in Ranger at a discount to NAV. And we weren't a part of the liquidation proposal, but we did see prior to the liquidation proposal being posted that there were allegations of the Ranger team misleading investors, there being improper information. And so when the liquidation proposal came out, we figured there was a pretty high probability that it was going to pass. And when it came out, it was at material discount to the cash value. And so, as I alluded to with the RFV slide, the only real outcome here is for the price of the conditional markets to move closer to the underlying spot asset. And so we were able to buy spot initially. So you see this pretty large move after the proposal was made, just because we saw it as potentially like not risk-free per se, but a fairly asymmetric opportunity. And then we were able to trade both sides of the market. So buy pass, buy spot, sell fail, and got the outcome that we're looking for. And then the last example, and this was talked about in a few other presentations, was the Solomon Gigabus proposal. We ultimately weren't planning on trading this decision market just because we didn't necessarily see it as particularly contentious. We just assumed it would pass. But ultimately, when someone came into the market and started trading against the proposal, the Solomon team reached out to us. We got on a call. We talked about the value of the proposal, and it became clear that it would be negative if this proposal failed, and it'd be marginally positive for it to succeed. And so, given that Solomon was trading at a discount to NAV, and we saw this as a value positive proposal, we were willing to trade aggressively against the other participant in the market. And ultimately, there were other people that started trading on our side as well. But as you can see, what started as a winning battle for the fail eventually flipped as the sellers, or I guess the people that were trading on fail, exhausted their marginal buying power. So these are just 3 examples. These are some of the market participants in decision markets. There's definitely a lot more to explore from the design space and order execution space within decision markets. Happy to chat more if you have any interest.
Noah's being awfully humble, but maybe we might have the world's leading expert on trading decision markets here. So I'm sure there's questions. Maybe just show of hands. How many people have actually traded a MetaDAO decision market? Oh, wow. Okay. There we go. Questions for Noah? Corey?
No.
Who else? Oh, no. Oh, okay.
Yeah, fascinating stuff. There's a kind of new market structure for Theia. Like, how much of it are you in it to sort of develop that thesis over time? Like, is your view that this is going to be a larger kind of phenomenon in the future, and part of what you're doing is building up consistency?
Yeah, definitely. I think that if we were to sum all of our trading activity and profits that come just from these decision markets relative to our fund size, it's relatively immaterial. And so I think it only makes sense for us to keep trading these markets, assuming that the market grows, and we assume that it will. So there's definitely an aspect of betting on the future. And then the other thing is, given that we're large MetaDAO investors as well as ownership coin investors, we're interested in that fundamental outcomes for all of those companies to be positive, and so want to be a part of it.
Do you feel like that creates a better alignment as an investor as looking at market price? Do you feel better?
Not specifically from trading. I think that as a byproduct of teams wanting a specific outcome and us generally being favorable towards what teams are looking for, they see us as a positive activist. But I think that just in general, it's very akin to, you know, having conversations with companies and kind of doing basic things that you would expect investors to do to improve their odds. So it's kind of the same thing as like portfolio support.
Good. Awesome. Thank you, Noah. It was awesome.